Welcome everyone to Vested Interest. This is Shane, and we are going to talk about it. We are going to talk about my market crash plan. What am I going to do if the market continues to drop, or even if the market bounces back for a little bit and then drops later in the year again? I do believe this is going to be a lengthy drop in the stock market. I don't think we're at the bottom yet. I do think we're going to get some bounces in between the bottom, but I do think we are going to bottom out later this year, maybe even into next year. Really depends on how the next quarter's reported earnings look, and if things are still slowing down with inflation. Really 8.3 to 8.2 is not the slowdown that we really need to see. We really need to see it dropping, from 8 to 6 or 8 to 5%. That would be a significant drop, and then the Fed maybe would lay off the 0.75 or even 1 full basis points that they're starting to talk about now. But with that said, let's jump right in to see what my plan is for the market crash if it continues. So here's 3 things I'm going to do. I'm going to book profits in overvalued stocks. So some of my stocks have run up significantly, 20, 30, 40, 50, even 60%. So in those areas, I'm going to book those profits, and I am going to then reallocate the profits into undervalued stocks. What's pulled back significantly at the time? I have 2 we're going to look at here in a little bit that I would really like to sink some money into if they drop back significantly. And then the third thing I'm going to do, I'm going to continue doing what I've been doing, continue to dollar cost average DCA into good growing companies that produce positive free cash flow. Free cash flow, that's what FCF stands for, so when you see that. Pay growing dividends covered by their free cash flow. Companies producing growing profits that have low debt and a high return on their invested capital. So the same thing I've been doing, the same thing I'll do next year and the year after that and the year after that. Regardless of how the economy is, I'm going to continue to dollar cost average into the portfolio as I have funds. Now let's take a look. Here are some of the areas, there are potential stocks I could sell that I could book some gains in. DTE, as you can see, I own 12 shares. It cost of $1,346. It's currently worth $1,587, up 17.94%. So I could book that 17% profit on DTE, and I'd have 1,587 to work with. I could do the same thing with Bristol Myers Squibb. I have 22 shares there. Looks like my price was $1,411.36. It's currently worth $1,714, so up 21.4%. So I could book those profits there, right? And then I'd have $1,700 to work with. Merck, I could sell Merck, 16.468 shares, right? I have $1,210 into Merck. I've up 27.25%, so I could book those profits. There's $1,539.59 there in Merck that I could book that. LMT, Lockheed Martin, I have 6 shares there. I wish I'd have bought more back here whenever I was picking this up. I have $2,009 into it. It's currently worth $2,580. So there's, I've made $580 on the $2,000 I had invested. I could book those profits. That's up 23%, right? LyondellBasell Industries. I actually really like LyondellBasell. They have a nice dividend payout. Same with Lockheed Martin, but I think they're around 2.2%. All these are pretty low, 2.5. None of these are real high. LyondellBasell, I believe, is above 3. So they have a nice dividend, and I have a significant amount in here, 42 shares, 42.60. So this is one that I'd not really look to unless there's really good deals. I'll show you the companies that I would sell these if something else opened up. Right, LyondellBasell, I have 42 shares. I've got 4,091 into it. It's currently worth 4,595. So I could book that 12%, 12.34% profit there. Kroger, I wish I'd have bought more whenever I was buying this initially. I was getting them at an average cost of $39.61 per share. They're at $48.66 now. I got 320 into it. It's worth $393. So I could book that 22.84% profit. Spartan Nash, another one I wish I'd have really loaded up. I've got 13 shares there. I was paying $20.22. It's currently worth $31.69. I put $268.91 into it. It's currently worth $421. It's almost double, up 56%. I could book that. And if I sold all of these or some of these or a portion of these, maybe I keep Lockheed Martin and LyondellBasell and I just sell these 2. That'd be $1,500, $3,000, $3,200, $4,700 if I sold those. So I'd have $4,700 to go put into something else, and I could keep Lockheed Martin and LyondellBasell. sell Kroger maybe, Spartan Nash, and then there's another 700, right? But if I sold them all, I have the potential capital of $12,833.45, which I would reallocate. Again, that was number 2. I would reallocate those funds. Where would I reallocate them? Well, I'd go to Apple, right? Currently, it's $137.59. I wanted to show you some things here. We're going to look at a dollar cost or discounted cash flow analysis that I did on Apple. So I used $137.59. That's the current share price. That's why it's highlighted. A market cap of 2.227 trillion. Okay, so that's another number to remember. This is all brought to you by Yahoo Finance, by the way. If you want to look at it, I looked at the last 6 months. You know, it's down quite a bit over the last 6 months, so it may continue to fall. Other things we look at, usually PE ratio, right, 22.42. Not too bad for a company like Apple, actually. Maybe a 18 to 20 might be better. Ex-dividend date, May 6. It does have a small dividend, a 0.67% dividend yield and 92 cents paid out over the year. They do pay out quarterly. Also, some of the things I'd look at, this is off their financial statement right here. Their gross profit, as you can see, 101 in 2018, 101 billion. These, it looks like million, but that's actually a billion. 2019, 98 billion. 2019, 2020 was 104 billion. 2021, 152 billion, and currently this year 167 billion. So you see it's steadily growing. You had one drop down that year, but then right back to growth year over year. Now on to the discounted cash flow model. As you can see here, we're looking at Apple. I entered it. This line here is their free cash flow. So we saw their WACC. I looked up. It is at 10.4%. So that's that 10.4%. That's where that came from. I looked at on Guru Focus. That's where I picked that number up from. All the other information is from right here, Yahoo Finance, right, for the free cash flow here. That's on their free cash flow page. So then I plug these numbers in. For 2018, goes there, 64 billion, 58 billion, goes in 2019, 2020, 73 billion, 2020, 2021, 92.95 or 253 billion. So then it does the calculation based on the WACC of 4. I actually did the WACC of 10.04. And I did a perpetual growth rate, so year-over-year growth of 4.5%. Now, I think Apple is supposed to grow something like 5 or 5.5%, so this may be a little low, but I want to try to be as conservative as possible. I looked up the shares outstanding. You can, again, just Google Apple shares outstanding. It'll come up. It's actually on Yahoo Finance's page as well. There's the shares outstanding, so I entered those in. And then it sticks out a price. The calculated stock price is $122.48. If everything here, it grows by 4.5%, the WACC, their weight adjusted cost of capital, how much money they're borrowing doesn't increase, it would be my calculated price. What I should pay for them is $122.46. If I want a 10% discount, I pay $110.22. And if I want to build in a 15% discount, I don't pay over $104. So to me, if Apple was to hit $122.46 or 110 or 104, obviously if it's lower the better, I would sell some or all of those previous stocks that we just looked at. The Lockheed Martin, DTE, LyondellBasell, Kroger, Spartan Nash. I would sell those particular stocks and I would buy Apple. That's what I would do with the funds. Now here's a couple other ones that I have that, you know, there's stocks on hold. I'm not, all of the stocks that we're looking at here, the ones above and these, I'm not adding anything except for the drip. And I'm thinking about taking the drip off because, to be honest, I feel like these are overvalued. You know, this is up 50, ExxonMobil up 53%, right? I've got 1,978 in it, and it's worth 3,044. So I could book that 53% profit. Chevron, 18 shares. I put 1,932 in. It's up 62%. It's currently worth 3,146.82, 3,146. So, you know, $1,100 in profit there if I wanted to book that profit. So I could, same thing, I could sell these. There's another 6,191 plus the 12,000 from those others if I wanted to sell. And what would I do with the funds? I'd go to Microsoft. It's currently sitting at $252.56, market cap of 1.889 billion. Again, let's look at the profit year over year, 72 to 83 to 96 to 115, currently 132, right? So continually growing year over year. That's what you want to see. And then here again, Microsoft discount cash flow model. We're going to look at the same thing. Here's the free cash flow, right? So 2018 free cash flow, 32,252 goes up here. 2019, 38,260 goes up here. 2020, 45,234 goes up there. 2021, 56,118 goes right here. It does the calculation. I again used 4.5% perpetual growth. It's WACC, weighted average cost of capital. That's what that means. WACC, weighted average cost of capital. That's how much they are borrowing. That's like the interest that they're paying on what they're borrowing. It's 8.65%. Right there is 8.65%. Shares outstanding I looked up, that was that number. It's currently at 252.56. The calculation says I should pay $219.34 if all this is true. Again, it's probably growing more like 6 or 7%. So I'm using a very conservative number. But if it dropped down to $219, $197 would be a 10% discount. $186 would be a 15% discount. If it dropped to that $219, then I would sell the others and I would buy Microsoft. That's what I would do with those other shares. So that's it. That's my plan for if the market continues to go down. I'm going to continue doing what I always do, dollar cost averaging week after week, integrate growing companies. If it gets real bad and the companies that I'm looking at, Microsoft and Apple, hit the number that I want them to, $122 for Microsoft and $122 for Apple and $216 for Microsoft. If it hits those two numbers, then I'm going to sell some of the ones that I have 20, 30, 40, 50% in profit in and sell those, book those profits, and buy the undervalued assets. And that is how you utilize your cash to build more cash. That's a compounding of your cash. I just took 22% profit, go back into something undervalued, and when that comes back up, I get that profit on top of the previous profit as well. So I can compound my own money if you do it right. So people talk about, they'll talk about diversification, but you should also be diversified with where your stocks are. All right, am I in the allocation phase where I want something real cheap? I'm getting something real cheap and I want to buy a bunch of shares, or has the stock gone beyond what I want to pay for it, and then I should look to book those profits, right? Because that's what we're looking for. A portfolio is to generate profits, whether that's in dividends or actual stock appreciation. If stocks get way out there, 50, 60, 70, 80%, I've got two that are 50, 60%, several of them actually that are 50%, and a bunch of them that are 20% that I've made in profits. So why not book those profits and lock in 20% gain? I just gained 20% on my money. So it's all right to sell something in your portfolio that's made massive gains like that if there's something that you can buy that's undervalued and make gains on top of that as well. So that's one of the strategies that I'm utilizing in this downturn. Guys, downturns are where a lot of money can be made if you play it right. Don't be afraid of the market downturns. Continue to dollar cost average. Continue to do what you've been doing. If you know the companies are good, if you've done your research, you've done it, like a similar discounted cash flow analysis or some sort of analysis to figure out the value of the stock, and you understand the revenue and the earnings and the debt that the company has, how many shares it has, is it buying back shares, is it selling? Apple is also buying back shares. I believe Microsoft is as well. So they're going to, more of their shares come off. As more of their shares come off, the price should go up as well. All right. That's all I got for this one. Let me know down in the comments what your plan is if the market crash continues. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit the thumbs up, ring the notification bell, subscribe to the channel, drop a comment below. Let me know what you think. I do personally read and respond to the comments. I'm always interested to read your questions, your opinions, or suggestions for future videos. Go ahead and drop those down below. Let me know how your portfolio is doing. I hope you had a great weekend. Appreciate you stopping by. Thanks for checking out the video. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you next time, guys. Thanks for stopping by. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria. Or seek the advice and counsel of a certified financial advisor.